Welcome and thank you for joining this Q1 2024 Centurion Apartment REIT Advisor Zoom webinar, of course, featuring Greg Romundt, President of Centurion Asset Management. My name is Paul Mayer, Head of Sales, and again, I will serve as moderator for this webinar. The Centurion Apartment REIT is Canada's largest private apartment REIT, now at AUM of over $7.4 billion, with an annualized rate of return since 2009 inception of over 12.6% a year. The REIT owns and operates a 158 property portfolio in 46 cities, which represents over 22,100 rental units. Greg, always a pleasure to have the occasion to chat with you. Q1 2024 was another solid quarter. Would you care to begin by highlighting some of the most notable results?
Sure. So really following on a very nice Q4 in 2023, that momentum really carried into the first quarter this year. So we'll go through some of the key stats. I mean, total same-store revenues were up almost 7% year on year. So this is same quarter over the quarter last year. Growth in property revenue, so that's up 11%. Growth in NOI, 15%. Same-store NOI was 8%. So the difference between those two is one includes the addition of new properties. The same-store one is just the ones that have already been known for 2 years. So we have a full comparable year behind it. 8% growth, again, well above the rate of inflation and exactly what we've been messaging we believe would be the case given the tightness of the market, and that's going to persist for a while. NOI margins continue to trend upwards, so 64 in a quarter, or 64.21 more exactly. Portfolio occupancy still very strong, stabilized at 98.7. And including the ones in lease up, it's 95.43. So also very good. The stabilized occupancy we've talked about, 1.5 vacancy as being kind of the theoretical, if you get 98.5% occupancy, you're basically theoretically full. It's very, very hard to get above that given renovations, the difference between move in and move out date. Proportion of stabilized portfolio continues to rise. We take more out of the newly bought or and put them into the stabilized category at about 82%. You continue to focus on the long-term mortgages. So our term weighted average mortgage term still six years at about 3.4% is average cost of funds. Interestingly enough, our mortgage investment portfolio under a year. So this is where we're making investments in mortgages or developments, and the coupon yield on that one is 13%. So still approximately a 10% spread between where we're borrowing and when we're lending. Leverage still staying quite reasonable at 47.75%. Kind of where it has been the last few months, the last few quarters. And the market rent gap continues to trend higher at 9.35, and we have a graphic for this as well.
So Greg, these are all impressive statistics. Is there any one particular stat that you're most proud of the many that are there?
I mean, look, it's all indicative of the last few years we've said we would deliver these kind of results. I mean, and say a specific number, we said, look, we'd strongly outperform inflation. We said that this strategy in this asset class was a reasonably good hedge against inflation, and we've outperformed inflation every year. So, and not to mention cumulatively. So if you look at our NOI today, they're saying inflation is 3%, and same-store NOI is 8% growth. So strongly outperforming, what I think a lot of investors care about, which is the maintaining the purchasing power. So I would say that, and broadly delivering on what we said we were going to do and what we said we're going to be able to do years ago. for the foreseeable future. So
Very, no, fair enough. Turning now to the rent to market rent gap.
yeah.
Kindly update us on that, and what kind of value actually do you anticipate being unlocked, with that particular gap?
So last year we took out almost 16 million of market rent gap. Now you'll see it didn't go down. So that's reflecting a few things where market rents are going up, and so we're putting some into the gas tank, so to speak, and at the same time we're realizing it, so we're taking out of the gas tank. So last year we net not only took out 16 million, which is call it just short of $380 million in value was taken out. Now we didn't get to keep all of that because of cap rates and what they did, but still a positive year. Because cap rates can move back down, and we think they will move back down, and that value will come back to us. But fundamentally, what I can't control what cap rates do. That's a market thing, but I can somewhat control what or influence, at least not control, but influence what's happening with their NOIs. And so the 16 we did last year, this year you can see from Q4 to the end of Q1. Now I anticipate to see a good result for the end of Q2, which is coming up shortly. But we increased the market rent gap by another 6. And as we've seen with NAV growth year to year, there's been consistent realizations as well. So I think we're in a similar range of 12 to 18 million, or possibly more, in realizations on market rent gap. But I think, as you can still see, these bars are still rising because this excess pressure in the market.
So now, broadening the lens somewhat, can you comment now on the current state of the Canadian multi-residential apartment sector, and then also maybe touch upon our financing side as well?
Sure. So, look, the market's still as tight as it always has been. That's an unfortunate reality, I guess, for most tenants. They, people trying to find rental apartments. There's just not that many. I would say that the government has done a number of moves in the last little bit, trying to alleviate the crisis, so to speak. Some of those have been positive about the financing side. So CMHC, about 2 weeks ago, announced some policies which will make it a little bit easier. One of which was, for example, that the restrictions on the use of capital when a developer was refinancing a property. If they had a non-bank lender, for example, a mezz fund, CMHC couldn't be used to take them out. So that made very challenging that if they had a non-bank lender, there's a lot of non-bank lenders involved in this space, that they would have to go to a bank, warehouse it there first. So, and then they could, so it was kind of like this administrative policy that they brought in during COVID, which was a little bit odd, but fortunately they seem to be getting the policy right. Financing market still functioning quite well. There's lots of capital available. The government's trying to make sure that there's capital available for construction. The problems are that it's very difficult to make deals pencil, like for a new construction point of view. So even with all that considered, I think that the supply of housing is going to get even worse before it potentially gets better. And part of that is a function of let's talk one about interest rates, right? So interest rates have made it very, very difficult for individual um, uh, condo owners, right? And to the extent that the condo owners can't carry their properties because their interest rates have gone up, and you know the city and the feds have hit them with these vacant or underused housing taxes. So if someone is sitting vacant, they could very quickly be hitting very high single-digit negative yields, which could quickly sink them. So and if you ever, there was a recent tax case a couple months back where if these condo owners had even rented their condo for a day on Airbnb, now they're going to have to pay HST on the entire value of their condo when they sell it. So that's 13%. So they made it very unattractive for a condo owner to be in the condo business. Now, politically, the narrative seems to be, well, we don't want financialized housing. Investors shouldn't be buying it. These are homes, not investments. This really represents a fundamental lack of understanding that about 80% of a high-rise construction building, like a new condo, is condo investors, right? It's not homeowners. Now, this just makes logical sense if you think about this for 30 seconds, because a building that starts selling today, now it's already taken maybe 2 or 3 years of entitlement to get to the point where they can start to sell, but they're going to start selling a condo which can be delivered in 4 or 5 years. Most people who are shopping for a house are doing it because, well, I've moved to the city, I've got a new job, I want a house now. I'm getting married, I'm getting divorced, I'm having children, having more children, something like that, right? So they want it now. They're not going to sign up for 4 years. Like, not many people know exactly what their life situation is going to be in 4 or 5 years. And so that's why we need condo investors in this space. And with the increase in capital gains rate and all these extra taxes and risks, it's made it pretty unattractive potentially for those people to be in that business. And they can't even qualify because now they, at today's interest rates, they go into a bank and try and get the mortgage financing, and they just can't cover it. Meanwhile, condo prices aren't coming down. So how do you bridge that gap? All of those things put together means if there's no condo investor, the developer can't do the pre-sales, which gets them the loan to build the place in the first place. So I think we're going to see, unless they change policy on this, a very significant decline in that amount of construction, like condo construction. And we desperately need condo construction, but it's dropping.
Yeah, in a sense that, that condo rental market will start to dissipate, which will further exacerbate, the need for apartment rentals, which makes what we own that much more coveted.
Yeah.
That's fascinating. Just turning very briefly to student residences, just turning our lens a little bit away from multifamily.
Yeah.
Is it still a question of private public partnerships in order to get supply?
Well, I know some others are focused on, buying stuff outside the campus, or we've not found any that are what I would call attractively priced or attractively located. So, I think that for us right now, we've not seen anything that we've liked in that space for a while. We continue to believe that there's lots of opportunity, but for us, I believe that opportunity is going to come because we're doing public-private partnerships. But the runway for those deals is very, very long. It takes a long time because governments don't move at the speed. Like, intent can be there, but they don't necessarily move because of procurement processes, and they may not have done one before, or PPP. What I mean, so these things can take a long time in getting board approvals, let alone the building times. But if you look at most universities in Canada, they, their stock was built in the 50s or 60s, and it does get worn. That it's normally built like bomb shelters, but it does get worn, and it really needs to be updated. And Canada has made itself an education destination. So, you hear all kinds of stories of students can't find housing. So they're sleeping in homeless shelters. So we've got a lot to do. And the universities don't get funding for building residences. So I really think there's going to be there's going to be a lot of opportunity for us there, but it's a very slow burn.
So the sales team is thrilled to be involved in promoting this recent $200 million, 2% discount to NAV capital raise initiative. So as we build our dry powder, what kind of deals are you expecting to see hit the market in the foreseeable future?
Like I've been saying for about a year and a half now, that I thought we were going to see this wave of deals, particularly in the new construction space, stuff that was built, that a developer had built spec, and they would, there would be some forced liquidity requirement. I was wrong on the timing, certainly, unfortunately, but that's okay. I've said we would get it when, we'd have a pretty good idea when the signal would come. And my view had been that, we would start to see that when we really saw the first cuts in rates. And, we've seen that. I've been talking about that was coming, and that would really start the next leg of the real estate cycle. So really the last 2 years have been about, okay, just focus on the business. But everyone's kind of been quiet for a bit. I do believe that CMHC has been very accommodative. The banks have been very accommodative, because they've wanted to avoid the market becoming stressed. And so we haven't seen the flow of the deals that I had anticipated would come, but I think that they are coming now, and that's why I want to get ahead of it and have a war chest to be able to attack it. Just like post COVID, right during COVID, we just locked down and said, okay, we're not going to do anything. But as soon as the government, decided they were going to print $350 billion deficit, the central bank was going to take interest rates to zero and enable that. We knew that was going to be inflationary, and we, bought $2 billion worth of property in a very short period of time. And we were right. And I think we're going to be right here too. I don't think it'll be as dramatic. But I anticipate the types of things that we'll see will be mostly new. That's where we're mostly interested in anyway. I think it's very hard to make the very old stock, like the value add product, work when there is no stock for existing tenants to go to. Those products are rent controlled, and you've got such a large gap that people are locked into staying. They can't move, right? And we've long believed in this thesis that the suburbs and exurbs are going to be where the action is. And for a new person coming into the country, they compare the rent that they could get in a suburb versus in a core Toronto in the space. The answer is obvious. However, for somebody who's in an apartment they've been in for 20 years and their rent is way down here, if they move to the suburb, they're going to pay more money. So they're going to stay. So it's very hard to buy those buildings where, historically, to get your return as an investor and to be putting the capital in that you need to maintain those assets, you really needed to see a turnover rate. And in Toronto, turnover rates now are 8 or 9%. So it's very hard for those deals to pencil. So I think those investors are going to have to hold for a while. So the activities are all, in my opinion, going to be in the new stuff.
And as that as the new stuff starts to hit the market, I mean, Centurion, as everybody knows, has a phenomenal operational platform in order to, manage these buildings. People are quite interested in some of the steps that we take to stabilize a building and operationally optimize its management. Care to comment as some of our tricks of the
Yeah.
trade as art to
Yeah.
extract as much value as possible from our buildings and still provide a great tenant experience?
So that's a good question. And I think it depends partially on the, whether we're buying a building empty and leasing it up ourselves, or it's a developer who's leased it up themselves and we're taking it. And why is that different? When a developer is selling a building and they lease it up themselves, their primary concern is to lease it up so that they can either hit a takeout financing target or to hand it off to a buyer and say, see, the building's full. And so that they can get their financing and they can move on. The problem becomes that because they're not a long-term owner, they may not care on the quality of resident they put in. So they may not be checking credit. They may not be checking if they have jobs or, whether they can make the payments or any of those things. So you can find that you have, a building which has been filled up too hastily. And so that's both an opportunity and a threat. Something that's been filled up too hastily likely means that it's under rented. But it also means that you might have to deal with people who moved in and never actually paid any rent and probably have no intention of ever paying any rent. So you'll have to go through that process. So our preference is generally that if we're going to buy a building, we're buying it empty or working with the vendor that will take over and will lease. So we control the lease up pace, and which means we're going to get, uh, we're going to get an appropriate price for the units. We're going to price it. We're going to manage the demand as we're going. And we're also going to control the resident quality. It normally takes us, even if we do that, it still takes you a period of around 2 years. Now this varies, right? So if you got an older building, it's going to take you longer if you have to do renovations, because that's very disruptive, right? So let's say you're going to have to go through the hallways or you're going to be doing an in-suite program. Well, guess what? All day long, every day, it's just, it's very annoying and loud. So that's not an attractant to new residents. So someone who's coming is going to want a discount, right? Or you're going to suffer higher vacancy. So you want to get to that point. Again, our goal is to get to the point as soon as we can where, we've reduced the annoyances to residents. So the resident experience is a good thing, where it's good. It's not, you're not getting that renovation noise, the dust, the dirt. The next thing that you want is you want your building basically full so that when you have something to rent, for example, a resident gives notice, now I've got 2 apartments to rent for June 1 or August 1, not 50, right? Because when you have one and 2 months time, your ability to try to get the best price that you can, because it doesn't hurt too much if you're off, right? And you have lots of time to adjust, right? When you have 50 units to rent, you just don't have, because that's going to hurt if you don't rent them. And so there's just a lot less flexibility that you have per dollar of risk, Like it's a lot more risky to try and say, well, we're going to try and price everything for all these 50. And if it doesn't move, now we haven't rented any. and now we've got 50 and 1 week less. So it's just a different position. And if you look at any of our reports going back years, we categorize into stabilized, unstabilized, and repositioning. And one of the myths, like I have to explain to most people, because they think, oh, in the repositioning properties is where we're going to see the fastest NOI and rent growth. Like, no. It always happens once they're stabilized, and that's been a consistent phenomenon for a long time.
It's fascinating. I mean, we could have like an hour to 2 hour discussion just on operations alone. And we just touched upon sort of leasing philosophies. And that's not even to mention the cost efficiencies, of running the buildings themselves. So that may be something. Yeah, you know what? I think we should explore that maybe in another webinar and a white paper, because we're noticing there's a great deal of interest as to how well we run our buildings. So let's turn to government just for a sec, because I think you have some nice words to say recently about government in terms of the trend. You always said that a concern has been excessive government intervention or regulation in the multifamily industry, but is the tide turning somewhat?
I believe so. I mean, I think that by they, I mean the politicians, recognize for seemingly the first time in the last year, um, that if they don't do something about the housing market, they're all getting fired. Now, I think they're all getting fired anyway, but and part of it is because this is the mess of their own making for a whole bunch of reasons. Um, but they do seem to be trying to bring in policies, which are on mass going to be helpful. So not all of these programs are going to move the needle, but the ones I think will be, the financing programs from CMHC. I do think the increased availability of those financings is going to be helpful, but they need to be expanded dramatically, not just a little bit. The moves to cut HST, that was a big one. Now we just need to deal with entitlements, right? So development charges, which are, and easily a third of the cost of construction. So if we can remove, or if we can remove that, a third of the cost of construction is government fees, taxes, and levies. So a third of that was the HST, and if we could remove the other third, so another 10% or so from development charges, this varies dramatically across the country. That makes a lot of buildings financially viable, right? So that's that, and if combined with addressing the development charges issue, if they can get to the rapidity of approvals improvements, and I think that we're seeing some. So the federal government has suggested linking. Now, this was actually a Polyev idea of linking federal capital spending to approvals, and I think that's actually a really great idea, and we should be doing that. Municipalities don't like it at all, but we should be doing that. So that would be, costs. If we can solve costs, and I think we're on the way. Second is solving financing. So that's helping. And then it's, we have to get to approvals, and the approvals is all about a couple of things. One is NIMBYism, right? So if we can deal with that, I think there's, if we can if the feds can say, well, sorry, if you want capital, you're going to have to do this. And so those municipalities are going to have to ignore their borders or pitch them that, look, we want $6 billion in capital. We need to approve homes. So that's it. And so I think things are moving in the right direction. The things that are unhelpful are, certainly the recent change in capital gains rate, which I think is going to take some of the capital away from the business, particularly on the condo side, because the rental industry can't solve this all, right? We need people, certain people want, I mean, 2/3 of Canadians, well, I would say a higher percentage of that want the chance to own a home, but 2/3 of Canadians do. Um, you know, so I don't think we want the solution to the housing crisis to only be one thing. It has to be a lot of things. It probably has to be a little of everything. But I do think that things are at least moving in the right direction, um, and that's a good thing. I am glad that they are. You know, the other thing that I would applaud, which I've been highly critical of for a long time, is the excess immigration rates. I think that they're still too high, right? If people are going to come to the country, they have to have a place to live. And right now, we don't have enough for the people who are already here.
And at least there's also a recognition that it's the private sector that's going to lead in terms of addressing this particular housing crisis. Forgive me, I know you've talked about this before, and I know that you are writing or have written, soon to be distributed, a paper on this. But one topic that continually comes up is the fact that the reconversions of empty offices into apartments is our panacea. Again, just any changes on that
Like
opinion at all?
I'll pretty much defer to this. I did write the paper. I think it should be published.
Yeah.
Hopefully, coincident with this webcast, so I'll direct people there. I will say no, hell no, no way would be
Just
my answer.
yeah. Well, I encourage people to read the white paper, just all the elements, the structural and architectural elements that preclude that solution. Um, Centurion is incredibly diversified, from Langford all the way out to the East Coast. What is the real advantage of having such a diversified portfolio in the multi-residential and student residence space?
Look, I mean, one of the things. I mean, it's simply put. You go back to any kind of market study on the benefits of diversification. It's one of the only free lunches that you have. You know, you very few investors have the ability, like we could, we are pretty much a macro type investor, right? So we are, where are people moving? Where can you build? What are things going to look like? Because when you build a building, you're building an asset that's 50 to 100 years, right? That you're going to have economic life out of it, depending on what you build and where. Um, so you're really making these long-term fundamental bets. Um, but things can happen in any particular neighborhood, which is going to be good or bad. So, for example, I happen to like the energy business. I really do. And I like Western Canada for that, not under the current government we have federally. Um, so, you want to have some there, but you can't have all of it, right? Because it's too much of a concentrated bet. And I would say the same thing about, you know, we've seen operators try to do single city funds, and they generally don't work out because you get one little hiccup, one reason, um, and it can be painful. Like COVID is a really great example, right? Because not only did you have the feds doing one thing, the province is doing another, and the city's doing another. So you could have been in a situation where, one province is doing something completely silly. And if you're all there, it's going to hurt, right? So diversification allows you to build resilience. And I think resilience, in my view, is one of the most important aspects of real estate investing. One of those things is don't over leverage. And the reason to not over leverage is so that, at any part of the cycle, you've got a path out, right? And if you take too much debt, you take too much risk, you're undiversified, one little hiccup can take you out. And this is a very good long-term asset class. You don't want to get shaken out at the first sign of trouble, or if there's trouble one place. So, I think that's really diversification is exceptionally important, not only in what we do, but in portfolios in general, because you want to get to the other side of any crisis and be there for the opportunity when things turn. So that's
Wow.
what I would say. Diversification is really important.
Really, really well said. Turning to one of your great loves, global macro.
Yeah.
Yeah, you were right. As you predicted, Canada cut interest rates before the United States, and the European cut, I would say, is discrediting a higher for longer interest rate thesis. So, comments on interest rates and where do they go from here?
Look, Canada has got a a policy rate which is far too restrictive. So if you look at official measures of inflation, and their target's supposed to be between 1 and 3, we're in the mid twos, and they've got a policy rate of 4.75. So we're, you know, call it 250 basis points too tight, give or take that range. The problem is that these high rates are going to cause inflation, as I've said, and I've been hounding on. Because if you cannot build the supply that we need in a deglobalized world for, our own manufacturing or services sectors that are having to be reshored, military spending. If you believe there's going to be a green transition, then that costs money, and we've got a, a population who's borrowed very, very heavily onto single family homes. And this renewal tsunami is going to be extraordinarily painful. And you can see the banks reserving very heavily against potential losses. And we've got a federal government who's taken doubled the federal debt in the 9 years they've been there, to almost 1.2 trillion. And we're going to still run a 40-50 billion dollar deficit into next year and forever. So current interest rates are not sustainable. They will get cut. I think they will get cut too slowly, and that there's going to be long-term structural damage to the Canadian economy that are going to take years to work out. I still stand by my view that we are in a structurally higher inflationary environment, and that we ultimately have to get down to negative real rates in Canada, because our productivity is so bad. GDP per person has been dropping for years. And if they just increase capital gains rates, so reduce the amount of the incentive to actually invest at all, I think it's gonna be real challenging. They're gonna have to cut rates, because it's gonna be a real mess otherwise for the Canadian economy.
And so as the interest rates get cut, what is there a lag before that gets reflected then in cap rates going down?
Oh, absolutely. So, you know, one of the things that there's this perception that cap rates, are pegged to 5-year or 10-year bonds, and they're just not, because a cap rate is closer to like an equity multiple, and interest rates moved up and stock rating multiples didn't go down, right? In fact, multiples have expanded in the last couple of years. So they're not directly related. I put out a paper, I think, over 2 years ago about why they don't necessarily have to tie, but they do trend together. And I do think we'll see it, but they tend to move longer term than shorter term. So it's something we're likely to see happen over, 12 to 18 months. But what we need is like, is a 25 basis point move and the Bank of Canada rate going to move cap rates? I don't think so. Either way, it wouldn't have made a difference. But if we're starting the trend and now it's down 50 or 100, and then you start seeing 150, and so then it starts to follow our market, because you're not buying a 5-year bond, you're buying a perpetuity, right? So it takes our market longer to be convinced, so to speak.
Fascinating. Wow, that's really great analysis. Um, so ending on a great high note is last week at the 2024 Wealth Professional Awards, you won CEO of the Year and Alternative Investment Provider of the Year. So it's a great sort of start, shall we say, to 2024, or at least recognition in 2024. What exciting opportunities then are you looking forward to towards the remainder of 2024?
Look, I really do think that we're, you know, we're starting the next real estate cycle here. Like, it doesn't feel it to a lot of people, but that's exactly when you're really starting to see the opportunities for the next cycle. Um, and I think we're going to see good deal flow. I think that'll be exciting. Um, Look, there's no question that Canada needs to build more housing in the next decade than has ever been built before in Canada at any, in generations. So that's got me excited. If it's any particular deal, no particular deal has got me interested, no particular segment. I just know that the market's going to be full of opportunities. And, we've been very patient and waiting for those opportunities, but I can just taste it, that it's very close. So that's why we're getting ready.
Greg. Greg, thank you so much for this Q1 update and for all your insights on all the various topics that we touched upon today. And so, on behalf of Greg and your sales team here at Centurion, we would like to thank you, the advisor, for your time and continued support. Should you have any follow-up questions, please do not hesitate to reach out to myself or your sales team. Once again, thank you for joining us and have a great day.
Thank you.